In this video, we break down what truly happened in crypto and trading over the past week. Bitcoin just closed one of its ugliest months in 2025, spot ETFs are bleeding billions, a major exchange got hacked again nearly 6 years after its last big exploit, and governments are quietly reshaping regulations from Central Asia to Australia. On top of that, one of Europe's biggest crypto asset managers abruptly cancelled multiple US ETFs launches, and even stablecoins are under scrutiny again. We'll walk through 7 of the biggest developments this week and explain why each matters, whether you trade daily, long-term, or just want to stay informed. Let's start with the price action and ETF flows because they set the tone for everything else. In mid-November, Bitcoin dropped to around 80,000, a 7-month low. Ether and many altcoins also fell as broader markets dumped risk assets. This drawdown wiped out more than 1 trillion USD from the broader crypto market valuation over the past 6 weeks. Part of the reason for the drop is investors lining up to exit. According to several industry trackers, US spot Bitcoin ETFs collectively saw nearly 3.7 to 3.8 billion in outflows during November, making it one of the largest monthly redemption events since spot ETFs launched. That's a major reversal from late 2024 when institutional outflows were among the main bullish drivers for Bitcoin and crypto in general. When big players stepped back, there was less buy and hold capital supporting Bitcoin, which contributed to the steep slide. Interestingly, some data suggests that outflows weren't uniform across all crypto products. Some newer ETFs tracking altcoins such as Solana or XRP reportedly saw net inflows during the same period. This implies some investors might be shifting capital from high cap assets like Bitcoin or Ethereum into altcoins, chasing potential upside while avoiding heavy exposures to Bitcoin's volatility. While this rotation doesn't necessarily bring stability, it means there are still pockets of demand, which could create interesting trading or speculation setups in altcoins. Towards the end of the week, as global equity markets improved slightly on hopes of a possible interest rate cut from the Federal Reserve, Bitcoin bounced back towards low to mid-90s. But does that mean the sell-off is over? Well, not necessarily. With ETFs flow still negative, macro risk unresolved, and sentiment fragile, this may end up as being what traders call a dead cat bounce. Here's why this matters. Prices down substantially from October high, institutional flows via ETFs have turned negative, meaning less build-in demand. But selective capital rotation into altcoins suggests some believe in value hunt plus risk-on trades. If volatility returns, expect wide intraday swings. Risk management becomes essential. Security remains the big risk in crypto, and this week proves it again. On November 27th, the biggest crypto exchange in South Korea, Upbit, reported a major hack of one of its Solana wallets. Roughly 44.5 billion Korean won worth of crypto was drained, which translates to about 30 to 37 million US dollars. Here's what we know. Upbit identified the unauthorized transfer, immediately halted deposit and withdrawal on the affected network, and secured other assets in cold storage. A follow-up report indicates Upbit itself lost corporate funds, around $4 million, but it reimbursed all customer losses from its reserve, showing the exchange had enough capital buffer to absorb the hit. The bigger red flag is South Korean authorities, quoted by Reuters, say the suspect, a North Korean-linked hacking group widely believed to be the Lazarus Group, is behind this exploit. This group has a long history of targeting crypto platforms to raise foreign currency for its country. There's also a symbolic element. This breach occurred almost exactly 6 years after Upbit's previous major hack in November 2019, reminding everyone that even big established exchanges remain high-value targets. Here's why this matters. Exchange custodial risk is real. Even top-tier platforms can be compromised. If nation-state actors are involved, we move beyond random hack risk. The security threat becomes systematic. For large traders and holders, relying on the exchange for custody becomes increasingly risky. Cold storage or self-custody may not just be optional, but prudent. Hacks tend to shake confidence, often triggering beneficiary sell-offs even beyond the stolen funds. Amid all the chaos, not all crypto news is negative. This week, one under-the-radar story marks a potentially significant regulatory shift in Central Asia. According to reports, Turkmenistan has passed a new law that legalizes and regulates digital assets, including cryptocurrency mining, exchanges, and trading, effective January 1st, 2026. The law defines the legal and economic status of virtual assets, sets rules for their creation, storage, and circulation, and establishes a licensing framework for crypto exchanges and mining companies. For miners, infrastructure players, and long-term industry watchers, this is a significant development. It's not just another ad hoc mining boom, it's a regulated, state-backed effort to integrate crypto into national economic strategy. This means that Turkmenistan could emerge as a new mining hub, potentially shifting global hash power distribution. Regulatory clarity may attract foreign capital, infrastructure investment, and institutional miners. As mining becomes more global and institutionalized, we may see increased professionalization in hardware provision, energy contracting and compliance, a shift from speculative mining to industrial scale operations. Australia advanced one of the most significant regulatory proposals in a major development market this week. According to regulatory reporting, the Corporation Amendment Bill 2025 was introduced to Parliament. It would place crypto exchanges and platforms defined as digital asset provider under the same financial services law that govern banks and brokers. Platforms would need an Australian financial service license and must comply with custody rules, settlement regulations, and client asset protection standards. Early stage or smaller operations may receive sandbox exemptions to reduce the initial compliance burden. The government positions the bill as a move to improve investor protection, increase institutional confidence, and integrate digital assets into Australian regulated financial system. Over the next 18 to 24 months, this could reshape which firms remain viable and how capital flows into the sector. Here's why this matters globally. A G20 economy setting stricter standards creates a powerful regulatory benchmark. Licensing costs may push out small exchanges and consolidate market share with large players. Compliance will be critical for platforms targeting Australian users. Clearer regulations could eventually attract more institutional capital. On the product front, a major asset manager abruptly pulled back. According to Reuters and industry filings, CoinShares cancelled plans to launch 3 US crypto ETFs, an XRP ETF, a Solana staking ETF, and a Litecoin ETF. The decision came days before a planned Nasdaq listing via a $1.2 billion SPAC merger. CoinShares said the US crypto ETP market is now heavily consolidated, dominated by a few large issuers, making new single asset ETFs unprofitable. The firm will pivot towards higher margin products, including blockchain equity funds, thematic baskets, and actively managed multi-asset strategies over the next 12 to 18 months. Here's why this matters. The US crypto ETF market is consolidating rather than rapidly expanding. Mid-tier issuers may struggle to compete with dominant players. Expect fewer simple ETFs and more complex actively managed products. Stablecoins faced renewed pressure this week. Reuters reported that S&P Global downgraded the reserve quality of Tether's USDT, assigning it a weak, the lowest rating on its scale. S&P pointed to a rising share of higher risk assets in Tether's reserves, including corporate bonds, secured loans, Bitcoin, and precious metals, as well as ongoing transparency gaps in disclosures. The agency noted that USDT has held its peg through volatility, but warned that stress event stability is not guaranteed. Here's why it matters. Traders and institutions using USDT as a cash equivalent now face higher perceived counterparty risk. Liquidity could shift to fiat or alternative stablecoins. Platforms relying heavily on USDT liquidity may see volatility pressures. Alright, for the recap, Bitcoin suffered one of its worst monthly drawdowns of 2025. Upbit was hacked again, losing tens of millions. Turkmenistan fully legalized and regulated crypto mining and exchanges. Australia proposed a major licensing bill for all crypto platforms, and CoinShares cancelled 3 US ETF launches. Tether's USDT was downgraded by S&P Global. Global risk-off sentiment dragged crypto down alongside equities. Make sure to like, comment, and subscribe for more weekly crypto news.